Financial freedom, passive income, and positive cash flow are the pinnacles of personal finance and investing. Achieving these milestones can mean the difference between a life devoted to a 9-to-5 job and one free to pursue your passions and interests. Hello everyone, and welcome to a brand new video on the channel. Today, we are going to talk about 10 assets that make people rich and never work again. Before we get started with the video, don't forget to smash the like button, share the video, and subscribe to the channel. Now let's get started. Imagine a life in which your assets work for you, generating enough revenue to satisfy not only your needs, but also your desires. From classic assets like real estate and stocks, to more unorthodox ones like intellectual property, each asset class provides distinct prospects for wealth growth and long-term financial security. Number 10. Investment properties. Real estate is a dual-purpose investment because it may create income, rent, and is often an appreciating asset. Most properties appreciate naturally over time, but you can accelerate your profits by reinvesting in the property to increase its curb appeal, appearance, or functionality. Real estate investors can also use equity from their existing properties to buy more real estate to rent out or flip. Number 9. Real estate trusts. Real estate investment trusts, REITs, manage real estate assets and enable individuals to participate in their properties in exchange for a portion of the profits. REITs often manage major commercial buildings, such as malls or resorts, allowing investors to select high-performing real estate assets at a lower risk and upfront cost than private real estate investments. Before you invest, understand that REITs are either publicly traded like stocks or non-exchange traded. Non-traded REITs are registered with the Securities and Exchange Commission, SEC, but they are not publicly traded and have no independent market value source. As a result, the asset's worth is not always transparent, and conflicts of interest may arise. Number 8. Retirement investments. Retirement is expensive, and the target savings for a good retirement are only growing. The sooner you start saving for retirement, the more cash you'll build through compound interest. Each year, you increase your retirement savings and earn interest on your entire investment. That interest compounded the next year as a portion of your investment total, and this process continues year after year, increasing your total interest profits. If a 25-year-old invested $5,000, never contributed again, and achieved a 6.5% annual return, it would grow to more than $62,000 in 40 years. If a 40-year-old did the same but only held the investment for 25 years, they would only have $24,139 by the time they retired at age 65. Number 7. Bonds. Bonds are a low-risk debt instrument for balancing your portfolio. When you buy a bond, you are lending money to a borrower, which can be a business, an individual, or the government. They pay back the debt over time with interest. Investors have control over who they lend to and how long the bond term is. Treasury bonds, which lend money to the United States government, are the most prevalent and secure bonds. You can buy bonds from firms, municipalities, and foreign governments, which may provide higher interest rates in exchange for more risk. Number 6. Stocks. While bonds stabilize your account, prudent stock investments allow you to generate money quickly. Stocks are riskier investments, but you can reduce the risk in several ways. Stocks represent equity. Therefore, you are purchasing a stake in a company. High-performing firm stocks rise in price, increasing the value of your shares and generating passive income through dividend payments. Long-term investments in blue-chip stocks have a demonstrated track record of growth, but cyclical equities are significantly influenced by economic conditions and may be more volatile. Investors buy stocks individually or as part of a fund. We recommend funds if you're just starting out, and there are a variety of investment strategies available. Your investment goals will determine which option is best for you. A certified CFP or other financial advisor can assist you with developing a stock strategy. Number 5. Farmland. Farmland property values, like investment real estate, rise over time as the land provides profitable goods and services. Investors prefer farms to hedge against inflation and market volatility because the asset is less affected by economic factors. We need to eat after all. Farmland is purchased either individually, through REITs, or through crowdfunding platforms. Individual ownership can be complex, so many investors use REITs. Crowdfunding is also popular, with benefits such as the chance to select specific investment properties. However, they are less accessible. Crowdfunding sites may restrict services to accredited investors, and fees might be expensive. Number 4. Small business investments. Business investments can yield excellent profits if you choose the right one and have control over how involved you are. Some investors desire to be involved in the firm through equity investments and strategy, while others lend money to the company in exchange for profits. Equity investments exchange money for some level of ownership. This is often far more complicated than loan investments, and owners can have varying degrees of engagement in operations. Owners have the potential for significant gains and regular dividend payments. However, because investments are inverted relationships, owners face a high risk of losing their entire investment and are accountable for the firm itself. Debt investments are similar to bonds. Investors make loans to business owners and earn interest payments in exchange. These investors are not liable for the company's profitability or operations, which can be a blessing or a curse depending on the company's performance and the investor's interests. However, debt is more secure because investors are the first to recover costs if the business fails, and the investment has a predetermined return rate. The best small businesses are constantly in demand, so they will earn revenue even while most individuals are feeling the effects of inflation. They do not have to be physical enterprises. Consider laundromats, relocation businesses, or dropshipping and catering. Number 3. Money market funds. Money market funds are low-risk market investments that distribute your cash among several short-term debt instruments. These could include securities issued by the government, municipalities, or corporations. These provide a good balance between low-risk, low-reward savings accounts and moderate-risk, moderate-return stock investments. You'll receive a consistent income that you can withdraw whenever you want without stress. However, it is part of a strategy and will not replenish your piggy bank. Number 2. High-yield savings. High-yield savings accounts, HISA, offer interest rates as high as 25% plus, a significant advantage over ordinary savings accounts, which average just 0.46% APY nationally. That's a $2,683 difference over 5 years for a $10,000 investment. To compete with traditional banks, online banks often offer HISAs, which have become popular as emergency fund accounts. They're simple to use, and you may withdraw cash whenever you need it. However, some accounts have minimum balance limits. Number 1. Index funds. Index funds invest in a variety of securities by tracking the performance of a single market index, a group of stocks such as the S&P 500. There is no active management of the account because it is a passive investment technique. This means lower fees and admission criteria. Index funds are a long-term play. The goal is to ride out any market volatility and pay out after a few years, such that overall performance outperforms managed mutual funds. They are frequently advised for retirement savings and can help stabilize your portfolio. That's the end of the video. I hope you liked it. If you did, let me know by giving it a thumbs up, and do not forget to subscribe. Thanks for watching. See you next time.